Let's talk about currency markets and the stories they tell. Specifically, let's talk about what happens when a number changes. On any given day, in any market around the world, an exchange rate fluctuates. It ticks up or it ticks down. And in the world of specialized currencies, a single downward ticket dip in the number of local currency it takes to buy $1 can trigger a tsunami of speculation, hope, and often profound misunderstanding. Today, we are going to deconstruct that single movement. Our focus is a hypothetical, yet instructionally perfect, scenario, the USD, IQD exchange rate dipping in both Baghdad and Erbil. But we are not here to hype a data point. We are here to understand the language of economics. That dip is not a secret message, it is a sentence in a long, complex story being written by policymakers, market traders, and international institutions. Our job is to learn to read that story with clarity, not emotion. By the end of this, you will understand the three primary forces that can cause such a movement, and more importantly, you will know the critical questions to ask to determine if it's a fleeting breeze or a sign of changing weather. First, we must establish a foundational truth that dispels 99% of the noise, *** in an economy with an active official market and a parallel street market. A synchronized rate movement is almost always a policy signal, not a market accident. ***, when the Central Bank of Iraq CBI announces its official daily rate, and when the traders in Baghdad's Al-Khaifa or Al-Harithia markets and their counterparts in Erbil's bazaars all adjust their prices in the same direction. It is a clear indication that a new piece of information has entered the ecosystem. This information is rarely a surprise leak about a future revaluation. It is almost always a tangible, present tense action related to liquidity, regulation, or enforcement. The market is a reactive organism, and this dip is its reflex. Our task is to identify what triggered it. So, let's walk through the three most probable and most rational triggers for a broad-based dip in the USD IQD rate. Think of these as the primary lenses through which any serious analyst would view this event. ***, Lens 1. Central Bank Intervention and Liquidity Management. ***, this is the most direct and powerful cause. The Central Bank of Iraq possesses a toolkit designed specifically to influence the dinar's value. One of its most potent tools is the daily foreign currency auction. Here's how it works. The CBI sells US dollars to licensed Iraqi banks. By increasing the supply of dollars in the banking system by selling more dollars than the market currently demands, the CBI can make dollars relatively more abundant and less expensive in dinar terms. This is basic supply and demand. Increase the supply of a thing, and its price in this case, the price in dinar tends to fall. A dip in the USD IQD rate means the dinar has strengthened. It takes fewer dinar to buy $1. If the CBI has recently injected a larger than usual volume of dollars into the market, or if it has tightened the rules for which transactions are eligible for these dollars, cracking down on fraudulent import documents, for example, it creates immediate, system-wide pressure. Banks, suddenly flush with easier to obtain official dollars, have less need to source them from the parallel market. This reduced demand on the street causes the parallel market rate to converge downward toward the official rate. This is not magic, it is monetary mechanics. The first question an analyst asks upon seeing a dip is, what were the CBI auction results for the past week? Was there a notable increase in volume or a change in policy? ***, Lens 2. Fiscal policy and government dollar injection. ***, the Iraqi government is a colossal economic actor. It earns revenues in US dollars from oil sales and spends a vast portion of its budget in Iraqi dinar on salaries, pensions, and projects. The process of converting its dollar revenues into dinar to pay its obligations is a primary driver of domestic dinar demand. When the government is actively executing its budget, when the Ministry of Finance is dispersing funds to provinces, paying contractors, and funding infrastructure projects, it creates enormous, localized demand for dinar. Think of it this way: to pay a contractor in dinar, the government must sell its dollars to the banking system to get dinar. This transaction supports the dinar's value. More importantly, once that dinar enters the economy as payment, it circulates, increasing economic activity and reinforcing the use of the local currency. If a synchronized rate dip coincides with a well-publicized phase of budget execution, say, the release of the second quarter allocations, is a sign that fiscal policy is actively strengthening the currency's footing in the real economy. The dinar isn't strengthening because of rumors. It's strengthening because it is being used at a massive scale for legitimate, productive purposes. The analyst's second question is, what is the current status of federal budget disbursements? Are there reports of large-scale salary payments or project launches? Lens 3. Regulatory enforcement and market sentiment. Currency markets, especially parallel markets, run onto fuels, liquidity, and confidence. Sometimes, the most powerful trigger isn't injecting new dollars, but forcefully altering the perception of risk for trading the old ones. A concerted, high-profile crackdown by Iraqi security forces and the CBI's anti-money laundering unit on unlicensed money exchange shops can cause a dramatic, if sometimes temporary, market shift. Why? Because it disrupts the channels for trading dollars outside the official system. It increases the perceived risk and cost of operating in the parallel market. Traders, fearing fines or closure, may temporarily adjust their rates to be less conspicuous or to offload positions. This can cause a dip. Furthermore, a major, positive statement from the International Monetary Fund, the IMF, following a review mission affirming Iraq's progress on its reform program, can bolster institutional confidence. If banks and large businesses believe the CBI's policies are credible and will be sustained, they may be more willing to hold dinar for longer periods, slightly reducing immediate dollar demand. This is a subtler, psychological effect, but in sentiment-driven markets, it is real. The third analytical question is, has there been recent news of enforcement actions against currency traders? Has the IMF or World Bank issued a new, positive statement on Iraq's economic progress? Now, having established the rational triggers, we must perform the crucial act of discounting the irrational narrative. This is where financial literacy separates from financial fantasy. Upon any favorable rate movement, a predictable course will immediately claim it is a preview or test run of a forthcoming revaluation. This claim collapses under the weight of its own logical fallacies. First, mechanism. Revaluation is not a secret that can be previewed in the live market. It is a sovereign decision that would be announced and implemented simultaneously across all official channels, freezing trade until new systems are activated. You cannot have a soft launch of a new national exchange rate. Second, scale. The dips we are discussing in this analytical framework are measured in fils, tiny fractions of a dinar. A true revaluation would involve a change of orders of magnitude, not decimal points. Comparing the two is like comparing a gentle slope to a vertical cliff face. They are fundamentally different geological features. Third, motive. No central bank on earth would ever deliberately leak its most sensitive monetary policy decision through the informal market. It would destroy their credibility and control. Therefore, interpreting a minor market fluctuation as a signal of a cataclysmic policy shift is not analysis, it is a form of pattern-seeking desperation, reading profound meaning into ordinary noise. So, what is the practical, actionable takeaway for an observer? It is to become your own analyst. Build your own checklist based on these three lenses. When you see a market movement, 1. Asterisk asterisk check the source data. Asterisk asterisk go directly to the Central Bank of Iraq's website. Look at their published auction results for the past 5 days. Note the volume of dollars sold and the exchange rate they were sold at. 2. Asterisk asterisk seek fiscal context. Asterisk asterisk read financial news from reputable agencies like Reuters or Bloomberg. Search for keywords. Iraq budget disbursement. Iraqi Ministry of Finance. Iraq project funding. 3. Asterisk asterisk gauge regulatory climate. Asterisk asterisk look for local Iraqi news reports often translated about enforcement actions or statements from the CBI governor regarding currency smuggling. 4. Asterisk asterisk compare and contrast. Asterisk asterisk is the movement isolated to one market, or is it seen in both Baghdad and Erbil? A synchronized move points to a systemic, policy-driven cause. A divergent move points to a local, regional issue like a delay in salary payments or a specific dollar liquidity crunch in the Kurdistan region. This process transforms you from a passive consumer of hype into an active interpreter of information. You are no longer waiting for someone to tell you what a price change means. You are equipped to build a coherent, evidence-based explanation yourself. In conclusion, the dance of exchange rates is a language. The dip of the USD, IQD, is a single word. Today, we have learned the grammar and syntax that allows that word to form a coherent sentence. We have learned that this word is most likely part of a sentence about asterisk central bank liquidity operations, asterisk or asterisk active fiscal policy asterisk or asterisk changing regulatory pressure asterisk. It is almost certainly not part of a sentence about a hidden, imminent financial revolution. The former sentences are about the hard, ongoing work of economic stabilization, a process that is real, measurable, and critical for Iraq's future. The latter is a fantasy that paralyzes rational thought. True understanding in finance comes from embracing complexity and rejecting simplistic fairy tales. By applying this framework of the three lenses, you ground yourself in the demonstrable reality of how money actually moves. You gain not a promise of wealth, but something far more valuable, the power of discernment, and in a world flooded with information and misinformation, that power is the ultimate currency.